Yesterday was the worst day in U.S. financial markets in months. CPI hit 4.2%, a three-year high. The Dow Jones crashed 953 points. The S&P 500 dropped 1.62%. The Nasdaq fell nearly 2%. And then, while markets were still reeling, Trump announced the U.S. had launched new military strikes against Iran after Tehran shot down an American Apache helicopter over the Strait of Hormuz. Gold, the supposed safe haven, fell to $4,124, down 25% from its January high. Everything investors thought they understood about this market was challenged in a single day. Today, I am going to tell you exactly what happened, what it means, and what you do now. Welcome to Financial News Daily. Here is the full timeline of yesterday, June 10th. 8:30 a.m. ET. CPI drops. Headline CPI, 4.2% year-on-year, highest reading since April 2023. Energy prices up 23.5%, accounting for over 60% of the monthly increase. But here is the critical split. Core CPI, which strips out food and energy, came in at just 2.9%. This is the most important detail most coverage missed. The inflation is almost entirely an energy story, not a broad economic overheating story. Why does this matter? Because the Fed targets core inflation as much as headline, and core at 2.9%, barely above the 2% target, gives Warsh cover to hold rates, even with headline at 4.2%. Markets initially sold off hard on the number. Then came the second shock. Midday, Trump announced the U.S. had launched new strikes on Iran after Iranian forces shot down an American Apache helicopter patrolling the Strait of Hormuz. Iran's Revolutionary Guard confirmed retaliatory strikes on U.S. targets. The ceasefire announced Tuesday, dead, in 48 hours. Markets closed near day lows. Dow Jones, down 953 points, minus 1.87%. Final close, 49,918. S&P 500, down 1.62%. Close, 7,266. Nasdaq, down 1.98%. Close, 25,169. Volatility index, up 12% to 22.22. And gold, which should have rallied on military escalation, fell to $4,124. That last point deserves its own analysis, because it tells us something very important about where this market is right now. This is the question every gold investor woke up asking. War escalated, gold fell. This seems to break every rule about safe haven assets. Here is the explanation, and it is critical to understand. Gold fell for three simultaneous reasons. Reason 1. Rate hike math overrides war premium. When CPI hit 4.2%, rate hike probability for December jumped to 70%. Gold pays zero yield. In a world where the Fed might raise rates to 4%, short-term treasury bonds yield 3.75 to 4% risk-free. Institutional money rotated out of gold into yield-bearing assets immediately. The rate hike fear was stronger than the war fear, in dollar terms, that day. Reason 2. The war is already priced in. Gold rose from $32.50 to $55.89 between October 2025 and January 2026. That $2,339 rally was almost entirely a war premium. Every subsequent military escalation has produced smaller and smaller gold bounces. The market has priced in a prolonged conflict. New strikes are no longer a surprise. They are the new normal. Reason 3. Citi's warning is real. Analysts at Citi warned yesterday gold could fall another 20% by September if the Strait of Hormuz remains closed. Why? Because a closed strait means oil stays high, which means inflation stays high, which means the Fed hikes, which means gold falls further. The war is now bearish for gold through the inflation and rate channel, not bullish through the safe haven channel. This is a complete inversion of the traditional gold playbook.
Gold at $4,124 has now closed below its 200-day moving average for the first time since October 2023. That is a significant technical breakdown. The next support level, $4,000. A break below $4,000 opens the door to $3,816, the level analysts at Light Finance have been pointing to as the bear case floor.
Now, the most important event of the next 7 days. June 16-17, the Federal Open Market Committee meeting. Kevin Warsh's first as Fed chair. Markets price 97% probability of a hold. No rate change expected. But the dot plot, released at this meeting, tells us where rates are going over the next 3 years. 3 questions that will define gold's direction for the rest of June. Question 1. How many hikes does the dot plot show? If the dot plot shows 1 or 2 hikes in 2026, gold tests $4,000 immediately. If the dot plot shows holds through 2026 and cuts in 2027, gold stabilizes and begins recovering. Question 2. What does Warsh say about core CPI? Core inflation at 2.9% is actually close to the Fed's target. If Warsh acknowledges this, markets will interpret it as less hawkish than feared. Gold could bounce $100 to $150 off that statement alone. Question 3. Does Warsh address the Iran war directly? The Fed rarely comments on geopolitics, but this conflict is directly causing 60% of inflation. If Warsh signals the Fed understands the inflation is supply-driven, not demand-driven, rate hike probability could fall sharply. The FOMC meeting next week is more important than any data point for the rest of June. Given everything that happened yesterday, here is the clear-eyed framework. Do not panic sell gold at $4,124. Here is why. Every major bank maintained their year-end targets yesterday. Goldman Sachs, $5,400. JP Morgan, $6,000. UBS, $5,500. Morgan Stanley, $5,200. These targets sit 25 to 44% above current levels. Central banks bought 244 tons in Q1 2026. China extended its buying streak to 18 consecutive months. That structural demand does not stop because of one bad CPI print. The structural bull case is intact. The short-term path is painful. The honest risk? Citi's 20% downside scenario takes gold to $3,300. That scenario requires Strait of Hormuz closed through September, Fed hikes in December, no ceasefire in sight. That scenario is possible, especially after yesterday. Give it a 25 to 30% probability. The base case? Gold finds a floor between $4,000 and $4,200. FOMC next week provides clarity. If Warkish acknowledges energy-driven inflation, rate hike fears ease. Gold recovers toward $4,400 to $4,600 by month end. For your portfolio right now, if you hold gold, do not sell. Let FOMC play out next week. If you want to add gold, wait for 4,000 as entry. That level has not broken yet. Let it come to you. If you hold defensive dividend stocks, J&J, PG, KO, WMT, LMT, yesterday confirmed why you own them. All 5 held significantly better than the broader market. Defense stocks actually gained on the Iran escalation news. If you hold cash, this week and next is exactly the opportunity your cash reserve was built for. June 10th, 2026. In one summary, CPI 4.2%, 3-year high. Core CPI 2.9%, near Fed target. The split is the key detail. US strikes Iran again. Ceasefire dead in 48 hours. Dow down 953 points. Gold at $4,124, 25% below January high. The counterintuitive reality. War is now bearish for gold through the inflation and rate channel, not bullish through safe haven demand. This changes how you think about gold's role in your portfolio right now. Your calendar for the next 7 days. Today, June 11. PPI data, 8:30 a.m. Eastern. Confirms or contradicts yesterday's CPI. Saturday, June 12. University of Michigan inflation expectations. If consumers expect higher inflation, that is the most stubborn signal of all. Monday, June 16, FOMC begins. Tuesday, June 17, FOMC decision plus dot plot. Warsh's press conference. The single most important financial event of June. Watch those dates. Everything hinges on next Tuesday. And the reminder we give every video. Everything here is for informational purposes only, not financial advice, not a recommendation to buy or sell. All data based on publicly available information as of June 11th, 2026. Please consult a qualified financial advisor before investing. If yesterday's chaos left you with more questions than answers, and today's breakdown helped clarify, give us a like and follow. We cover every move, every day. Your financial future matters. Stay informed, stay ahead. See you tomorrow. Financial News Daily.